We continue our coverage here at Davos 2023, and joining me now is Neeraj Kanwar of Apollo Tyres. Neeraj, thanks very much for being back here in Davos with us. What's the outlook for 2023? I mean, continues to be a fairly difficult environment for auto companies. What does the year hold?
Well, I think it's going to be a very challenging year. As we know, inflation is high, energy prices are very high. There is a recession in the market. When I look at India, India is doing very well. We're seeing the CV cycle coming back. We're seeing the passenger car cycle coming back. So that's going good. Agri is in a downturn, but I expect by April, season should come in and agri should come in double-digit numbers. So that's a good sign. Europe is challenging, very, very challenging. Energy prices have gone up at least 5 times. So raw materials are very expensive. There is a recession. Miles driven on the road have come down. So challenging time for as far as Europe is concerned.
So what is that going to mean now in terms of demand? What is it going to mean in terms of capacity utilization? What is the current capacity utilization for?
So in Europe, actually, we are running at 90-95%.
Okay.
So as far as Apollo is concerned, we are doing fairly well. Markets come down by -14, we've come down by -5. So we are outpacing the market. We're grabbing market shares just because of the tires that we've come out with are good in technology. We are going after the ultra-high performance tires, UHP, so we're gaining market share in Europe. So capacity in Europe is 90-95%. As far as India is concerned, we are running at 80-85 because the CV cycle was down. Now we are seeing the CV cycle coming up in this quarter. So I'm hopeful that utilization will go back to 90.
So you wouldn't need to add any capacity at this point in time, given where you see demand and utilization.
But you know, we are using a lot of AI and machine learning. We're trying to de-bottleneck our plants and trying to see how we can increase productivity. So in our Hungarian plant, using AI and ML, we've already increased by 20% productivity. So small capexes, not major capexes. No idea about looking at a brownfield or major expansions in the coming year.
What's the outlook then in terms of margins, given the pressures that you spoke of? Some of the cost pressures, though, have eased.
Yes. So raw materials have eased. Like you said, natural rubber has come down. Crude prices have come down. So margins will expand. Also, we are looking at more profitable segments of the market. So in passenger cars in India, we're going on the higher segment. So looking at more richer product mix, thereby giving us release in profits. So I'm hopeful that EBITDA margins will start going back up.
So outside of Europe, which seems to be at this point in time the big risk factor that you're dealing with, what else are you worried about?
Well, demand is a big concern, obviously. Energy prices is a very, very big concern. Availability of raw materials also is a big concern. So these are some of the challenges. I think supply chain was a challenge during COVID. Prices of freight had really gone up. They've started softening. So that's given us some ease on supply chain pressures. So yeah, I think it's going to be a difficult time, a challenging time. But I think we have to all look inwards, try and see how we can de-bottleneck, control our costs, control our overheads, and try and come out profitable.
When you said that we all have to start to look inwards, not just from productivity and an efficiency point of view, does that also mean that India is going to be get disproportionate amount of the share of bandwidth as well as focus?
I think India is on a trajectory, and I think the economy is growing at 6.5%. So all our focus is to see how we can grab more market share in India, how we can improve our balance sheets in India. And throughout the company, when I'm talking inward, we are also looking at trying to see how we can correct our ratios, especially our balance sheet ratios. We're looking at free cash flows. I think cash is going to be king this year. So we have to look inwards to try and see how we can make our cash flows have more free cash flows. Our rate on capital employed has to go up. And so those are the things that we are looking at. We're looking at seeing how we can sweat our assets much more, trying to get more productivity out. So yes, India Inc. is the way to go, is what I believe.
So what are the targets that you've set for yourself in terms of improvement, both as far as ROCE is concerned, bringing down debt, etc.? What are you working towards?
Our vision is to see that we get above 12% on ROCE, and that's what we are working towards.
By when?
In the next 2 to 3 years. To 12 to 15% is what we're looking at. And I'm pretty sure that the entire company, the entire 19,000 people of the company are really focused on improving the rate on capital employed.
So 12% in the next 2 to 3 years.
Yes.
Okay.
Definitely.
You know, in terms of growth, what's the expectation given the slowing environment?
Well, you know, I'm a pretty optimistic guy. I believe in double-digit growth, so we will continue to have a double-digit growth.
You feel confident of being able to deliver on that?
Definitely.
Neeraj Kanwar, always a pleasure. Appreciate you joining us here on CNBC-TV18. Thanks very much for your time, and thank you for being part of the Future Female Forward campaign.
Thank you. Thank you. Congratulations.
Thank you very much. We are going to take a break and come back with more conversations here at Davos 2023. Don't go anywhere. We're back in a minute with more.